everyone, and welcome back. We're diving deep today into a topic one of you requested, and it's all about passive investing.
Oh, yeah. This should be interesting.
After reading that article, Passive Investing, the boring but effective investment choice, you were really curious. And to be honest, so am I. Boring, but effective.
Right.
Those two words don't usually go together.
They don't usually hang out much.
So before we decide if passive investing is too good to be true, let's break down what it actually is.
Sure.
What is passive investing?
So passive investing is all about trying to match the market's performance rather than beat it.
Okay.
And the most common way to do this is with index funds.
Okay.
These funds basically hold a basket of stocks that mirror a specific market index.
Like the S&P 500?
Exactly. You got it.
So instead of trying to pick individual companies or time the market perfectly, you're basically riding the wave of the entire market's performance?
Yeah, you're going with the flow, and it's surprisingly effective. Yeah, a report from Bank of America Global Research actually found that only 36% of actively managed large-cap U.S. mutual funds beat the Russell 1000 index in 2024.
Less than half.
Yep.
Wow. That's a pretty big deal.
Yep.
What about the other 64%? What happened to them?
Well, it really shows the potential of passive investing.
Mm.
And it's not just a one-year thing either.
Oh, really?
Data from S&P Dow Jones indices shows that 86% of actively managed funds underperformed the S&P 500 over the past 3 years.
Wow.
And get this, over a 10-year period, it only dropped slightly to 85%.
So this boring approach is quietly and consistently winning the race. But why? What's the secret sauce?
Well, there are a few key things that contribute to passive investing success.
Okay.
One is the structure of index funds themselves.
Right.
Because they just track an index, they require less active management,
So that means...
lower fees for investors.
Right, of course. And those fees come directly out of your returns over time.
Right. Even small fees can make a huge difference in the long run.
Yeah, how much are we talking?
Imagine this. You invest $10,000, and your active fund charges a 1% fee.
Okay.
Compared to a 0.1% fee for an index fund, that's a $90 difference each year.
Okay.
Over 20 years, that's $1,800.
Okay. Yeah, I see how that adds up. But it's not all about fees, right?
No, not at all. Another huge advantage is diversification.
Ah, diversification.
Index funds inherently invest in a wide range of companies.
Right.
This spreads your risk out so you're less vulnerable to the ups and downs of any single stock.
Don't put all your eggs in one basket.
Exactly.
It's good to have a safety net, especially when it comes to your investments.
And then there's the historical performance data.
Right.
We've already seen some of the numbers. Passive investing has consistently beaten active management over the long term.
So that's pretty solid evidence.
It is.
Okay, so we've got lower fees diversification and a strong track record. It sounds like we're building a solid case for passive investing. You mentioned the Russell 1000 earlier. Can you remind us what that is and why it matters in all of this?
Of course. The Russell 1000 is an index that tracks the performance of the 1,000 largest publicly traded companies in the U.S.
Okay.
It's a snapshot of the large cap stock market. Large cap meaning companies with a high market capitalization.
So the big players.
Exactly. And like we talked about, it's the index that less than 40% of those actively managed funds were able to beat in 2024.
So is this saying that just investing in a simple Russell 1000 index fund would have given you better results than going with those professional fund managers?
Well, that's what the data suggests. And interestingly enough, in 2024, the Russell 1000 saw a lot of growth driven mainly by those big tech giants.
Like
Apple, NVIDIA, Microsoft, Amazon, Meta, the big ones.
Yeah, so is this reliance on the tech sector sustainable for passive investors? Or could it be a risk?
That's the million-dollar question a lot of people are asking.
Yeah.
Some experts think tech is here to stay, while others worry about a potential bubble. It's worth keeping an eye on.
Okay, so lots to think about there. But let's zoom out for a sec. Is this outperformance of passive strategies something we're seeing across other indices too? Or is it specific to the Russell 1000?
It's definitely not just the Russell 1000. Take the S&P 500, for example.
Another big U.S. stock market index.
Right. In 2024, the S&P 500 had a 25% return.
Wow, 25%.
And only 19% of over 1,900 U.S. stock mutual funds and ETFs managed to beat it.
So no matter which major index you look at, it seems like passive investing is holding its own.
And then some.
And then some. And this trend has caught the attention of some big names, right?
Oh, yeah, for sure.
Like Warren Buffett.
You got it.
He's a big fan of index funds.
Huge fan. He's a vocal advocate for passive investing, especially S&P 500 index funds.
And he's not just anyone.
Right. He's Warren Buffett. He once said, the best thing to do is to own the S&P 500 index fund.
He really believes in it.
He does. He believes in its simplicity and effectiveness.
So he's basically saying, keep it simple.
Pretty much.
Coming from him, that's a powerful endorsement. Why would anyone choose to do anything else?
Well, now hold on a second. There are still reasons why some people might prefer active management.
Okay.
And we'll get into those in a bit. But first, let's talk about why this passive approach might make sense for you, our listener.
Yes. Let's bring it back to you. What are the key takeaways here?
Well, we've touched on them throughout our conversation.
Right.
Lower cost diversification and a proven track record.
The Holy Trinity.
That's a good way to put it.
Yeah.
These are the cornerstones of why passive investing has become so popular and successful.
Yeah, and when you put it like that, it's hard to argue with the appeal. Let's break each of these benefits down a little further.
Sounds good.
Okay, so first we have the impact of fees. We talked about how passive funds generally have lower fees than actively managed funds.
Right.
Why is that again?
Because they don't need a whole team of analysts constantly picking stocks and doing research.
Less overhead equals lower costs.
Makes sense, right?
Right. Now, what about diversification?
Diversification is all about spreading your risk. When you invest in an index fund, you're automatically invested in a bunch of companies across different sectors.
So if one company or sector isn't performing well,
It won't have as big of an impact on your overall portfolio.
so it's like a built-in safety net.
Exactly. It helps you handle those natural ups and downs of the market.
And last but not least, let's talk about track record. You've mentioned this a few times now. I'm curious to hear more about why it's so important.
It's important because the track record is the evidence. It shows that over the long haul, passive investing has consistently done better than active management. And this isn't just a recent trend. This pattern has been observed for decades.
So the data speaks for itself. It's not just some theory. It's a strategy with a history of success.
Yeah.
Okay, so we've defined passive investing, looked at its advantages, and even seen real-world data that supports its effectiveness. But there's got to be more to this story, right? We can't just ignore the fact that active funds still exist.
Oh, there's definitely more.
And some people swear by them. So why is that?
Well, investing isn't just about numbers.
Okay.
Psychology and emotions play a huge role, too.
Are you saying our brains can sometimes trip us up when it comes to making smart investment choices?
Sometimes, yes.
Okay, so what about passive investing specifically? What unique challenges do passive investors face when it comes to managing those emotions?
One of the biggest ones is market volatility.
Ah, yes.
Even though passive investing is supposed to smooth out those bumps over time, it doesn't mean you won't see ups and downs in the short term.
It's like watching your favorite sports team lose a game. Even if you know they have a great record overall, it still stings when they don't win.
That's a perfect analogy. And just like with your team, it's important to remember the bigger picture.
But that can be hard when you're seeing your investments go down. So what are some practical tips for staying calm when the market takes a dip?
One tip is to focus on what you can control.
Like what?
You can't control the market, but you can control your reactions.
Right.
Avoid making rash decisions out of fear or getting greedy.
Don't let your emotions drive the car.
Exactly. Stick to your plan and avoid the urge to buy when everyone's buying or sell when everyone's selling.
Makes sense. What else?
Another good technique is to reframe your perspective.
How so?
Instead of thinking of market drops as losses, try to see them as opportunities to buy more of your investments at a lower price.
Like finding a silver lining.
Exactly.
Yeah.
It's a way to stay positive and focused on your long-term goals.
I like that. Okay, focus on what you can control. Reframe your perspective. What else?
Remember, investing is a journey, not a race.
Ooh, I like that.
You'll hit some bumps in the road, but if you have a good plan, a diversified portfolio, and that long-term mindset, you'll be fine.
It's not about getting rich quick. It's about building wealth slowly and steadily over time.
Exactly.
And that takes patience, discipline, and managing your emotions.
Well said.
And speaking of managing emotions, you don't have to go through this alone.
So true.
Talking to a financial advisor or even a therapist can be really helpful.
Absolutely. Investing doesn't have to be a solitary activity. Sharing your wins and losses and concerns can make it less stressful.
And more enjoyable. Exactly.
Great advice. We've covered so much in this deep dive. The what, why, and how of passive investing, the psychology of decision-making, and even how to manage the emotional roller coaster. But before we wrap up, is there anything else our listeners should keep in mind as they navigate this world of investing?
You know, we've talked a lot about diversification,
Right.
but there's more to it than just spreading your risk across different companies or sectors.
Oh, there's more. Tell me more.
It's about diversifying across different asset classes, too.
Oh, interesting.
Stocks are just one piece of the puzzle. A good portfolio should also include things like bonds, real estate commodities, and precious metals.
So even if I'm all in on passive investing, don't put all my eggs in one basket, even if it's a diversified index fund.
Exactly. Different asset classes tend to behave differently under different market conditions. By diversifying across different asset classes, you reduce your risk and smooth out your returns over time. Okay, diversification is key, both within asset classes and across them.
You got it.
This has been incredibly helpful. We've really covered a lot today, from defining passive investing to understanding its nuances. We even talked about the psychology behind choosing between active and passive approaches. But there's still one piece we haven't fully addressed, something that's probably on our listeners' mind.
Yeah, you're right. We focused a lot on data strategies, pros and cons, the logical side of things.
Right.
But we haven't really explored the emotional side of investing. How do you handle those feelings when the market does something unexpected? How do you avoid making impulsive decisions based on fear or greed?
Great questions.
And that's exactly what we'll be tackling in the next part of our deep dive.
All right, listeners, we're about to get into the minds of investors. Stay tuned. We'll be right back. Welcome back. All right, so before the break, we were talking about the benefits of passive investing.
Right.
Lower fees, built-in diversification, consistent returns. It was starting to sound pretty tempting. But we also pointed out that active management is still a big part of the investment landscape.
It is.
So why is that? Why do people still choose active management?
Well, investing isn't always just about cold, hard numbers.
Okay.
Our emotions and psychology play a pretty big part, too.
I knew there had to be more to the story. So are you saying that sometimes our brains can actually sabotage our chances of making smart investment choices?
Yeah, sometimes. For some investors, active management has a certain appeal.
Like what?
The thought of beating the market,
Okay.
that potential for outperformance. It's the idea that a skilled fund manager with all their expertise and resources can pick those winning stocks and get returns that are better than what you'd get with a simple index fund.
Right, I get it. It's kind of like the thrill of a treasure hunt.
Exactly.
Who wouldn't want to find that hidden gem of a stock and watch it skyrocket?
It taps into that competitive spirit we all have, the desire to outsmart the average investor. And honestly, there's something appealing about having someone, a stock picker, actively managing your money for you, making those big decisions.
Yeah, it feels more personal.
Especially in a world that's becoming more and more automated.
Yeah.
And there's the element of control, too.
Oh, how so?
With active management, you can choose a fund manager whose strategy matches your specific goals and your risk tolerance.
So you're not just passively going with the flow.
Nope. You're being deliberate about it.
So it's not always about greed or trying to get rich quickly?
No, not at all.
There can be real reasons why people choose the active route.
There are. And to be fair, there are some active fund managers who consistently beat the market.
Okay, but...
They're the exception, not the rule. The data shows that.
Right.
They do exist.
So it's not as simple as it might seem at first. There are good and bad sides to both approaches, so how do you decide?
How do you pick the right path? Passive or active?
Right. How do you know which one is better for your own situation?
That's the question every investor has to ask themselves. And there isn't one right answer. It's depends on you.
On me.
Yeah. Your risk tolerance, your time horizon, how much you know about investing, even your personality.
Wow. Okay, so there's a lot to consider. Let's break those factors down one by one. What questions should our listeners be asking themselves?
Well, first think about your comfort level with risk.
Okay.
Passive investing is generally a more conservative approach. Remember, you're not trying to beat the market, just match it.
Right.
So your returns will probably be steadier, but potentially lower than what a high-risk, actively managed fund might achieve.
So if you're someone who loves to gamble for a chance at those big wins, passive investing might not be the most exciting option.
That's true.
Yeah.
But if you value stability and peace of mind, passive investing could be a really great way to grow your wealth slowly and steadily.
Makes sense. Risk tolerance checked. What's next?
Your time horizon is also crucial.
Meaning?
How long are you planning to invest this money for?
Oh, okay.
Passive investing is usually seen as a long-term strategy. It's about riding out those short-term market swings and focusing on growth over years or even decades.
So if you're saving for retirement or a down payment on a house years down the line, passive investing makes sense.
Exactly. But if you need the money sooner for a short-term goal, maybe a more actively managed approach might be better.
Okay, I see the difference. So we've got risk and time horizon.
Uh,
What else should we be thinking about?
how much do you know about investing? What's your experience level?
Mm.
Passive investing is often called a set it and forget it approach, which can be great for beginners or people who don't want to spend hours researching companies and market trends.
Like the easy bake oven of investing.
Kinda.
Mm-hmm.
But with active management, you need to have a deeper understanding of the markets.
Okay.
Be willing to put in the time to research and be able to analyze different strategies.
So if you're someone who enjoys digging into the numbers and strategizing, active management might be more your thing.
Exactly. It gives you more control and lets you personalize your investments.
Right. We've got risk, time horizon, knowledge level. You also mentioned personality as a factor. How does that play in?
Some people are natural do-it-yourselfers. They like to be in control and involved in every step. They enjoy the challenge of trying to beat the market
Okay.
and that sense of accomplishment that comes with choosing winning stocks.
So those folks might lean towards active management.
Right, because it lets them be more hands-on.
While others might prefer a more laid-back approach.
Right.
Where they can trust a system that's been proven to work over time.
Exactly. Passive investing takes out a lot of the guesswork and lets you focus on the long game.
So ultimately, it comes down to knowing yourself,
Your goals.
your goals, and choosing the path that feels right for you.
Exactly. There's no right or wrong answer.
Yeah.
It's about finding what gives you the best chance of reaching your financial goals and feeling good about it along the way.
Great advice. We've covered a lot the pros and cons of both passive and active investing, the psychology behind those choices, and we've even given our listeners some key questions to think about. But before we move on, is there anything else they should keep in mind as they navigate this investing world?
I think it's worth revisiting the idea of diversification.
Okay. We touched on that
But
earlier.
there's more to it than just spreading your risk across different companies or sectors.
There's more. I'm intrigued.
It's also about diversifying across different asset classes.
Different asset classes.
Stocks are only one part of the picture. A well-rounded portfolio should include other things too, like bonds, real estate, even things like commodities or precious metals.
So even if I'm all in on passive investing, I shouldn't just put all my money into one basket, even if it's a diversified index fund.
That's right. Remember, different asset classes tend to behave differently depending on what the market's doing. By diversifying across different types of assets, you can help lower your risk and even out your returns over time.
Got it. Diversification is key both within asset classes and across them.
Exactly.
This has been so helpful. We've covered a lot today, defining passive investing, understanding the pros and cons, looking at the psychology of decision-making. But there's one thing we haven't addressed yet, something our listener might be thinking about.
You're right. We focused a lot on the logic, the data, the strategy.
The rational side of things.
Exactly.
Yeah.
But we haven't really explored the emotional side. How do you deal with those feelings when the market does something you weren't expecting? How do you stop yourself from making impulsive decisions based on fear or greed?
Those are great questions.
And that's exactly what we're going to dive into in the next part of our show.
And we are back for the final part of our deep dive into passive investing.
It's been quite a journey.
It has. We spent a lot of time talking about the rational side of things, the data, the strategies, the pros and cons.
Right, all the logic.
But investing isn't always logical. It can be a pretty emotional roller coaster.
Oh, absolutely. Emotions play a huge role in how we make investment decisions, often without us even realizing it.
You're right. We're not robots after all.
Right.
So how do we handle those emotions? Especially when it comes to passive investing, which is all about taking that long-term, hands-off approach.
That's the million-dollar question.
Yeah.
It's something every investor struggles with, whether they're just starting out or they've been doing this for years.
So how does it work? How does passive investing play out emotionally? What are some of the unique challenges passive investors face when it comes to keeping those emotions in check?
Well, one of the biggest challenges is dealing with that market volatility.
The ups and downs.
Exactly. Even though passive investing is designed to smooth things out over time, it doesn't mean you won't see those short-term fluctuations.
Right.
And when you see your portfolio value drop, it's natural to feel a little bit of fear, maybe even panic.
Oh, yeah, I get that. It's like watching your favorite sports team lose a game. Even if you know they have a great record overall, it still stings when they don't win.
It's a perfect analogy. And just like with your team, it's important to remember the bigger picture, to remember why you chose this strategy in the first place.
That's easier said than done, though, right? Especially when you're seeing those numbers go down. So what are some tips? What are some things you can do to stay calm and collected when the market takes a dip?
One helpful tip is to just focus on the things you can control.
Like what?
Well, you can't control the market, but you can control your reactions.
Oh, right.
Don't let fear or greed make you do something impulsive.
So don't let your emotions take the wheel.
Exactly. Stick to your plan and resist the urge to follow the crowd, buying when everyone's buying, selling when everyone's selling.
Okay, that makes sense. What else can you do?
Another good technique is to kind of reframe your perspective.
Oh, how do you do that?
Instead of viewing market downturns as losses, try to see them as opportunities to buy more of your investments at a lower price.
Like a sale at your favorite store.
Exactly. It can help you stay positive and focused on those long-term goals.
Okay, so we've got focus on what you can control. Reframe your perspective. Any other words of wisdom for our listeners who might be feeling those emotional ups and downs?
Just remember, investing is a marathon, not a sprint. There will be bumps along the way, but if you have a well-thought-out plan, a diversified portfolio, and that long-term vision, you're setting yourself up for success.
So it's not about getting rich quick. It's about building wealth over time.
Exactly.
Hmm.
And that takes patience, discipline, and being able to manage your emotions.
Well said. And speaking of managing emotions, it's important to remember you don't have to do this alone.
That's so important.
Talking to a financial advisor, a trusted friend, or even a therapist can be really helpful.
It really can. Investing doesn't have to be a solo mission. Sharing your journey, your concerns, your successes can make it less stressful.
And more enjoyable, too.
For sure.
Well, we've covered a lot of ground in this deep dive, the ins and outs of passive investing, the psychology of decision-making, and even how to manage the emotional side of things. Before we wrap up, is there anything else you want to leave our listener with, something for them to ponder as they continue their investing journey?
While we focus specifically on passive investing, those emotional skills we talked about are valuable for any investor, regardless of their strategy.
That makes sense.
Self-awareness, managing your reactions, seeking support when you need it. These are all so important.
It really highlights how personal growth and financial growth go hand in hand.
Absolutely.
Well, on that note, a huge thank you to our expert for walking us through this deep dive into passive investing. And to you, our listener, thank you for joining us. We hope this is giving you the knowledge and the confidence to make those informed decisions as you navigate your own financial path. Keep learning, keep exploring, and remember, the world of investing is vast and full of possibilities. Until next time.